This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth Toil. My name is Luke Laretive and I'm from Seneca Financial Solutions, and I'm here today with my partner in crime, good friend Dylan Pargiter-Green. DPG, how are you, mate?
G'day, mate. I'm well. How are you?
Oh, back from my little sojourn down in your neck of the woods in Tasmania. Very nice to have a quiet frothy in the Clarendon Arms Beer Garden with Dill over the long weekend. Good to see you down in your natural habitat down there, mate.
Yeah, I was. I had my wombat skin on, and
he was wearing shorts, which didn't surprise me. In the middle of winter.
I'm wearing shorts right now, so you know it's the thing. I think what doesn't kill us makes us stronger.
The two takeaways from my trip to Tasmania were no pants and no teeth. There we go. That's my. Mate,
look, it was good to see you, and I think that we should all acknowledge, just for the listeners out there, how nice a weather it was for your entire trip down in Tasmania as well.
It was very nice, very nice.
Very nice. Yep, I think you might have even picked up a tan. Not something you'd get in rainy Melbourne, but that's fine. Anyway, mate, we're not here to talk about Tasmania.
Much.
We are much. Maybe we should do a whole episode on Tasmanian markets.
I can guarantee you that's never going to happen.
No, but we are here to talk about finance. And today I think we're going to talk a little bit about an article that you recently wrote for Livewire. Check the show notes, because that is what people say on podcasts. But no, on thematic ETFs, and where there's a bit of a myth on thematic ETFs about whether or not they should be used in a well-diversified portfolio, whether or not they should be used as satellite positions. And there's a lot of buzz around them. I think since ETFs really exploded maybe 5, 6, 7 years ago, they have become, quite a thing.
Yeah, man. I think
the kids.
They're just really popular, and I can understand why they appeal. I suppose, like a lot of things in finance, they just don't actually work. So, and you don't know what you don't know. And that's what we're here to do. We're here to fill in some of those gaps on what people might know, and, pass on some data and some evidence, rather than just sort of talking out of our, 50-year-old sayings and lingos and rules of thumb, and actually get down to the nitty gritty. And, it all sounds fantastic buying the semiconductors or the cybersecurity ETF. But does this stuff over the long run actually add any value? And, I would argue, if you look at the data, and you can look at the article for yourself, but I would argue no. And I would certainly say that, I've seen, doing these portfolio reviews I've been doing lately, it is the way people are investing. They're buying a couple of low-cost index tracking ETFs, which is exactly what they should be doing if they want to run a low-cost index strategy. But rather than sticking to the kind of fundamentals, they're off playing spicy satellite with high-cost thematic ETFs, because they want to be part of the whatever revolution, insert word here, and over long run just detracting from their returns.
I think there's this misconception for a lot of new investors that ETFs are free. There are fees on ETFs, like even your simple index tracking, Vanguard, VanEck, Beta Shares, whoever it might be. they could be as low as 0.02% on some, but a lot of these thematic ones, like the fees are not
60
small.
bips, 70 bips. It's not unusual. So sorry, I shouldn't use bips because people don't always understand.
Yeah.
So 0.70%, so 0.7%. So, people go to me, oh, look, what do you charge to be a client of Seneca and for me to manage your money? Well, it's anywhere from 50 basis points or 0.5% to 1%. So you can get someone like me to manage your money for you, an active manager, for sometimes less if you've got enough money, sometimes less than what an ETF provider is offering. So, I find it quite interesting that people are so willing to hand their money over to BetaShares or Van Eck for for 25% of the process that an active manager conducts. Say, if you were talking about a quality filter that they apply in one of these quality ETFs, when in reality an active manager is doing the rest of the investment process and only charging you a fraction more, if any, sometimes marginally more. So I think it's one of those situations. Price is what you pay, and value is what you get. And I think the value for money in these sort of pseudo-active, filter-based, factor-based ETFs, whilst I don't think they're particularly egregious compared to the sort of sexy thematic stuff, certainly it isn't a good deal. And people are using them to try and optimize their portfolio. In reality is you'd just be better off buying an active manager who employs a kind of more sophisticated version of the same thing for an extra 10 basis points.
Yeah, or in some cases less. I think that before we jump right into this, because it does sort of sound like we're ETF bashing, and we're certainly not.
I am.
I think that really, really importantly, what you said at the start, right? Indexes are still a really crucial part of a very entry-level portfolio, and they can do amazing things for people. I think
I've got no market cap weighted index. I've got no issues with it, and I think like if you're happy with the those sort of returns, that's fine.
And people will have been happy with them because indexes have done incredibly well for the last 15 years. After GST, particularly the
GST.
US. Sorry, the the GFC. I think I should have made a coffee and not a peppermint tea before.
Should have had those 3 pints before you had do this podcast.
Yeah, what time is it? It's 12 o'clock.
3 o'clock.
Yeah, somewhere. No, after the GFC, like the index has done incredibly well, and indexes generally. But a really good example of that might be that if you had have bought just the ASX 200 instead of buying an all-world index, you would have done significantly worse. And that's a very broad, decision to make. There's a lot of Australian investors who prefer to invest domestically just because they know the household names. But this is the power of a world market-weighted index. It's that you get exposure to lots and lots and lots of different things in a way where you wouldn't otherwise be able to do that.
100%. I think the market weighted, if you were talking about a pure theoretical strategy, it really is. It's black and white from my perspective. The middle ground, I think, is a little bit half pregnant and doesn't really make a lot of sense to me. Either you think that you can't outperform markets, nobody can, or you can't select anybody who can, don't have access to anybody who can, and you're happy to just fractionally underperform by about 30, 40 basis points on average if you look over the long run on the price of a multi-asset strategy. You should just invest in either, if you're happy in 100% equities and you don't really need it and you're younger and you want to maximize your returns and happy with the volatility, in an MSCI all-world type product, and you just reinvest all of your distributions and compound, and that would just add to it regularly, or a risk profile appropriate multi-asset ETF, so one of those ones that's got conservative, balanced growth, high growth as a name or equivalent. And pick your poison, pick your provider. They all are the same. That it's not that much difference between the two. It doesn't really matter. Certainly doesn't matter as much as saving regularly or reinvesting your distributions. And that's all you need to know. If that's what you want to do, and you don't think there's anyone out there who can outperform, fine, go for it. You don't need an advisor. You don't need anyone to tell you anything. You can talk to Dill about your goals, and you don't need an investment manager, and you'll save lots of money and you'll feel great about it. Or you can be like me, and you can have your eyes open. You can be actively looking, and you'll see there are really good, consistently performing managers out there across the asset classes, and you can try and build a portfolio of those that give you a similar exposure in terms of totality to what you would have at an MSCI World or at one of those particular risk-profiled ETFs, but with primarily or even all active managers. You'll have a higher fee load, but hopefully you're going to have higher after-fee returns as a result of making those decisions. Now, I think this whole thing breaks down when people start to jump over here to active management, but don't benchmark, don't evaluate their decision making, don't see if their tactical tilts add value over time. Don't worry, all the work they do, they don't actually see if it's worth doing. And for a lot of people, it's not worth doing. And if they're going to do it themselves, they'd be better off probably over with an ETF style product that's tracking an index. And for the pros like us, we're scored against everybody else every day, and we try and compete for capital out there, and that's how it goes. But
I think the other thing. So one of the points you make in your article is that a lot of the time people are using these thematic ETFs to fill a satellite position, but I don't think that they understand when they're doing this that they're doubling up in a lot of senses. So someone might say, okay, well, I want to have 50% of my money in like a world index, great. And then they want to have 25% in a high yield Australian ETF, and then 25% in, I don't know, the FANGs, right? So Facebook, Amazon, Apple, etc. If you're buying the world index, 60 odd percent of that is America, of which 30% is that top 10 companies in America. If you're then taking that, you've already got an overweight position to that due to the nature of the index. If you're then taking another 25%, you are putting more than 33% of your overall wealth into 10 companies.
At which point you have to ask yourself, are you active? Are you an active manager or are you a passive manager? And do you and if you're making that much of an overweight bet in something, are you really trying to track the growth of profits and GDP globally in a super diversified, no non-systematic risk way? Or are you just creating a pseudo overweight portfolio based on size? And I would argue that making investing in these satellite opportunities is primarily scratching a behavioural itch, a bias to try and feel good about investing, try and feel better and smarter and cleverer, and I've made a bit of money here and I've done okay. It's like, no, make enough decisions, you'll make more errors than you make correct decisions, and Dunning-Kruger will get everybody, and that is pretty much how it works. And I think, yeah, you're 100% right, mate. Like the lack of understanding around what goes into these products is a big reason why at Seneca, we love our separately managed accounts. I know you use them as well. Is because they have that level of transparency, and whether that we can use that as a teaching aid, whether we can use that as to better understand our investments, whether we can use that to help us avoid having those behavioural itches to scratch, because we're actually a bit more attached to the kind of investing we're doing on a day-to-day basis because we can actually see it happening. I think is well worth the price of admission.
Yeah, I think I can't remember where you got this from, but I remember you saying that you need to reevaluate your portfolio at 10 a.m. when the market's open every single day. And if you wouldn't invest in that company for the amount of money that you have in it right now, you should sell it.
I'm pretty smart, I'll tell you what.
But an index fund somewhat, makes those decisions for you. I love that behavioural, concept that you're talking about, right? We tend to hang on to our winners, but we also tend to hang on to our losers. how do you make that decision if you're just buying every semiconductor company that you can? You're going to end up with more losers.
These companies, I mean, for starters, if you actually understand how these index products rebalance, some of them are a bit skew-if, right? They reinvest in the stuff where the market caps go up. So essentially, you're buying more of the winners, but that's in a land of smaller mid-cap companies without the number of stocks that are in a broad-based index. Often ends up you buying the overhyped stuff that kind of gets carried away more than you are the stuff that maybe just hasn't quite run yet, or is more slow and steady, wins the race type sort of theory. So it's not really, as much as it feels good to buy the semiconductor ETF, it's not really the optimal deployment of that particular thematic from an investment professional's perspective. So I think if you like, I'm picking on semis here because of the Nvidia, and I know you're interested in it, Dill, but like there are managers who have got really good market expertise around semiconductors. You should probably just invest in their product because they've got the same interest area, but a professional execution instead of some system, or what I would call a flawed systematic strategy when it comes to allocating portfolio weights. And I think it's important that people realize that ETFs are just another fund. They're no different from an active fund or a passive fund, or whatever you want to label it. There's only two types of funds, and no one uses these terms, but these are the only two types of funds that exist. There are systematic strategies, i.e. there is a set of rules that a computer automatically inputs that determines how much money goes into each security inside the investment universe, aka an ETF, or any other system or way of allocating money that you want to choose. Some people, momentum strategies, quant strategy, a lot of hedge fund strategy use the same sort of systematic ideas. And then you have discretionary funds, like ones I run, and the ones that Regal and Airlie and every other fund manager that you've ever heard, GQG and Magellan, they all run the same. They are run by a human who uses their discretion to determine how much money to put into a select set of securities from inside a particular universe. So it's very simple funds management, but we all like to label it and set it up. Oh, excuse me, my phone is ringing. I did not put my phone on silent, and my options clients give me a call. I will deal with him later.
Podcast takes preference. That's
mate,
good.
Priorities. My priorities. That's money on the phone there. I'm leaving behind.
I think one of the other things is that a lot of the trend on a lot of these ETFs is driven through media, because people will see a trend, people will see a certain macro trend that will be popping up in the media a lot. So I know you said we're picking on semis, but like pick another one, right? The listing of some of the cryptocurrency ETFs. Like I've had conversations with clients over the last 3 months, 6 months, probably since they launched, and none of them could tell me whether or not they actually held an underlying asset of cryptocurrency in these actual ETFs. They didn't know what was in them. It was, when we dug a little deeper, we found a whole myriad of different things under different things. You can go on to a broker and buy that stuff directly if it's what you're interested in. In the same way that if you can go and pick 5 companies that you actually believe in the semiconductor space or the AI space or whatever it might be. But if you don't feel like you've got the discretional capability to go and buy the 5 companies that you believe in, do you really think that you should be just shotgunning, the wall of balloons and hopefully one of them has a prize inside it?
I think the reality is it's been made to feel, buying ETFs and whatever ETF, as long as it's an ETF, buying ETFs to the general public has been made to feel safe. It's been made to feel normalized. It's been made to feel that if you wait long enough, you can't lose. And I just think that bias that's been created in society is now being leveraged by these ETF providers to prey on people's reliance on historical returns as the primary decision factor point. And all they do is they go and back test a portfolio of stuff that kind of all fits in the same box, figure out what's worked for the past 6, 12, 24, 36, whatever months, and then whack a product together, get it to market, whack 60 basis points on it, call it thematic that everyone's raving on about at the moment, and then pillage $15 billion worth of assets until it dies 3 years later, which is the average lifespan of these ETF products, which tells you exactly everything you need to know about thematic ETFs. And
I think the terms ETFs and index investing have gotten confused for a lot of people.
I agree.
They
100%.
are different. They are different, right?
ETF. I mean, I can have an ETF tomorrow. I can go get a Luke ETF that buys bags of rice and stores them in my cupboard, and creates a price index for
You
the
just have
value.
to pay for it.
No, it creates a price index for the value of that, and as long as I can convince an ASX custodian, one of the preferred custodians, that I've got a reasonable basis for that valuation. The reality is I can create a unit price for that, and sell units in a trust that hold those grains of rice in my cupboard. ETFs are no different. Managed funds are no different. Active ETFs are no different. They're just managed funds. They're all just managed funds. They're either a systematic strategy or a discretionary strategy. And I think what everyone needs to start thinking about is that if it doesn't track the MSCI All World Index or a large geographically focused index, i.e. the ASX 300 or 200 or whatever, which is pretty small in the grand scheme of things, but forget about it for now, an S&P 500, Euro stocks, a Euro stocks 350, whatever. Just if it doesn't track one of those, it's not an index ETF. It's not, and if it doesn't charge you less than 20 basis points, it's not low cost. So, if your goal is to do low cost index investing, it's really easy. Just go and buy one. You can pretty much have a one stock portfolio. Yes, it will be boring, but yes, it will work, and you won't waste your money paying for Alex from Beta Shares next Lambo. I'm serious. The guy's a billionaire. He's literally pillaging people on a daily basis.
And all
power to him. All power to him. I'm just jealous.
All power to everyone that wants to go and do that, because that's your discretion. You can do whatever you like with your money.
Yeah, but you're a muppet if you do.
It's not what we would. It's not what we would recommend.
People often think I don't really say what's in my mind. They think I'm a bit of a indirect communicator and don't really sort of to put my opinion. Don't like to put my real truthful opinion out there. That kind of thing. I think I've been known to hold back too.
Yeah, I'm sure I've seen that once. So one of the cool things about an index is that you're constantly reweighting to whatever the market cap is. And the idea is, or what has historically been the case over a very long period of time, is that you will experience overall growth, albeit at a steady and not a specific stock level. One of the other issues that probably we see with these thematic ETFs is by the time that you know about them, a lot of that growth in a sector has been already priced in. So I think you made another point about this in the article, which was, we don't like buying things at the top of the market. We don't like
no one wants to do that. Yeah, but everyone
wants to do that, right? So we, as people that are picking investments for our clients, we're looking for opportunities where things have fallen or where things feel undervalued. Buying into the top 10 companies in the NASDAQ, they are expensive. Nvidia, I know we talk about Nvidia a lot and I don't own it. I think that it is 360 times valuation too expensive.
I'm glad he's been paying attention. I think episode 1 he was telling me he was going to buy a little bit, and I beat it out of him subsequently.
Well, how do you know that I didn't buy it and then have subsequently either won or lost on it and sold it?
I don't, but I bet you haven't.
I didn't.
I bet you bought.
You know what though?
I bet you bought more Seneca Australian Shares SMA. That's what you should really.
I bought more market weighted index over that time. That's for sure. So I own plenty Nvidia.
You do
plenty of Nvidia, I should say.
I'd argue too much.
Yeah, there you go. There's your argument there. But so going back to this, right? So we unfortunately, the nature of a lot of these is that they are, by the time that you have heard about it, you will be behind.
Correct.
If you're reading about it in the paper,
most likely.
Most likely. So,
but Dill, perfect example. There's a perfect example, and we haven't done market wrap this week, but consider this bit the market wrap. Chinese equities have been getting absolutely belted for like 18 months, and we've sort of been nibbling away, adding weight, tilting up in our global equity SMA. And last week, US dollar denominated Hong Kong equities, Chinese equities in HKD were up 4.8% for the week, the best performing market in the world last week. And they're now up 15.6% for the quarter, which is the best performing of any region on the planet. So I didn't know at what point over the last 6 months when we were adding weight to Chinese equities that they would bounce. And we're probably still only, probably not the full 15% up on what we paid for it. But the point I'm trying to get here is the valuations got way out of whack with where they normally are, and sentiment generally always turns. And what we're seeing now is the values come in. People are like, look, these stocks are cheap. I'm going to start buying them. This looks really good at the moment relative to US tech, which is nosebleed, make my eyes water type valuations. And you got
just want to point out as well, episode 5, I think it was episode 5, episode 6. Emerging markets was a real highlight.
Yeah, we talked about wait then. It's and 5 weeks ago.
But it's not like we chose on that week. We're like, actually no, we put all of our clients overweight Asian equities that week. Both of us have been doing this for
months,
probably, I've been doing it for more than a year, for the reason that we feel like there's value there.
And so,
I'm certainly not picking a.
I haven't checked GQG's number. I mean, they had a ripping March, but the GQG emerging market strategy would have had a pretty good, because the second top performing region this week has been India, which is up 2% for 2.4% for the month rolling. So I think they would have had a really good, which is where they're overweight. And Fidelity Asia, which is our other active manager in emerging markets, probably has ripped because they're super long China and they've been getting torched. So, it's about getting into this stuff at the right time. It's about having good ideas. It's about thinking about things, logically and sensibly and doing your work. But all I'm trying to say here is, I suppose, is that you can just sit in a bench, index, MSCI or world, and you'll be fine. Like, I'm not saying your return's going to be bad and this isn't going to happen, but at the moment, say for example, I might, if the MSCI or world's 63% US, I might only want to be 43 at the moment, or 53, and so because there's a good opportunity somewhere else, and for that reason, that's a good enough reason for me not to index.
Yeah, absolutely. And I mean, that's another point, right? So even if you are buying a world index, generally you will be behind on a lot of these trends. And this is where perhaps a role of a manager that fills a satellite position can actually provide that additional value rather than you trying to pick a particular thematic.
If you can pick the thematic, what's the point of having a core? Just put all your money in. If you think semiconductors are so good, put all your money in semiconductors. Now, you shouldn't do that. But my point is that your logic's flawed. And do you think
it's a case of when we hear something that is growing so quickly, we think that we have a because this, therefore sort of mindset? So,
I mean, it feels pretty good to be able to say, hey, I don't have to make a choice. I just get to buy this thing, which is labeled the thing that I want. But I mean, my mum calls me handsome, and I mean, that's not necessarily a true label either. And it's
good days and bad days.
It's not. The label on the tin doesn't always represent what you think it's going to get you, and doesn't get you what you want. And I think further to that, most of the time, the reason why people put satellites together in the first place and don't just have everything in their core is because they want to have a go at something. They want to have a punt at something. They want to, I just do this on the side. It's going to go well. It's going to not go well. And then it'll either go well and they'll be happy about it and then probably do another investment which won't go so well because their process is dog shit, or they'll do or it won't go well, in which case they'll go, there wasn't much invested there anyway. My core's gone up and made up for the difference. But all you've done at the end of the day is dilute your returns from a good process over in your core with garbage in your satellite. And I don't care whether it's small cap stocks. I don't care whether it's you trying to do pick sectors or thematics or be overweight something. I can almost guarantee you it's not as good as what you should be doing and what you should be doing.
I think that's a really good point on small caps as well, because of the companies that last within an index, the majority of them are larger companies that have sustained long-term high income.
A large company starts out small, deal.
That's true, but in the point, hear me out. You're going to have a lot more losers in a small caps index than you are in as a percentage. You're going to have a lot more losers in a small cap index than you are in a total market index.
Correct. And the weights in those stocks are going to be a lot higher too. Now, Benny and I have also written extensively about index construction, and in fact, in our small cap fund initial introductory presentation, we covered we did so much work on this, like deep diving into index construction for the ASX Small Ordinaries, and why we think if you're an index investor in that index, that's the dumbest money you can possibly deploy, because the nature of the index. Now, if you want to talk about this in detail, I am happy to do that with you, but it's probably beyond the scope of this 40-minute podcast, which is currently at 32 minutes. So, look, I know a lot about that particular topic, and I'm happy to talk to anyone through it in detail. But just trust me when I say what happens is at the top end of the index, and the way the stocks are included that fall out of the 200, they're often structural losers or cyclicals, and it means that the small cap index buys the cyclicals at cyclical lows and holds them for extended periods of time before they graduate, and then most of the momentum and upside happens in the larger index. Down the bottom of the index, there's a lot of overhyped up, no revenue, no profit stocks that come into the index. You end up buying quite a lot of them, and they detract significantly from returns. It's part of the reason why a top quartile fund manager over the last 5 years in the Small Ordinaries world and universe has outperformed the market by 8%. There shouldn't be that much alpha on offer in an efficient market. If you're looking at ASX 200 land, there'd be 15 managers in Australia who have got better than 2% compounding alpha over the long run. So 8% is huge. That exists for a reason, and it exists because there is opportunities to generate alpha, but partly because the benchmark is inherently flawed.
Yeah, 100%. The another reason why, when you're picking your portfolio, doing your research beyond what a trend might be or might be happening is really, really important. And I think that's another really interesting point. We might have raised it in a previous episode. If we haven't, I think we should talk about it some more. But in the different market sectors, the capacity for outperformance and what the degree of that outperformance is.
Yeah, we'll go asset class by asset class, and I will.
Yeah, that's a good idea.
Prepare for the next episode. So next episode we'll talk about what active can do for you in asset classes and what's realistic and how much it costs you.
Yeah, and perhaps we do, Oz, world.
We'll do Oz large and small. We'll do world large and or maybe developed emerging markets large and small, and might look at PE as well. Maybe some private stuff too. Looking at you there, seeing if you want to do that. You might get me on a rant about our esteemed superannuation system and how the reporting standards are not we are not all born equal when it comes to reporting standards. Do not go to a chartered financial planner conference and start talking about industry super funds. It is like red carpet at a bull. It's a red cloth at a bull, not carpet.
It's funny, right? And they are all not equal. I love some of those funds, and I won't name them because
I don't love any of them.
Yeah, well, you know, there's certain ones that do really good stuff, but there's others that are
Australian super
hiding things. You can't say that. They've got big.
I didn't say anything.
They've got big lawyers.
I didn't say anything.
No, but before we go, I think there was probably a couple of nice little things that we might want to talk about just in terms of the markets.
What is with the balloon still? For those who are listening, on the video, Dylan has had like an AI balloons go up, and now he's doing the rock star. He has some sort of Apple.
It's just FaceTime. So Apple introduced this like feature, and it happens all the time by accident. If I'm counting on the screen more often than not, there'll be balloons. Anyway,
very good. Okay, so you want to do what else? Do you want to do? What else do you want to cover?
So market wrap. You briefly touched on how Asia, China has had a really good week or month, was it?
Quarter.
Really good quarter. We're in the middle of a quarter, so I don't know how.
Well, rolling.
Okay, rolling.
12
quarter.
weeks. Yeah.
But a couple of interesting Australian stories that came out. So one that came on the news this morning, and I was reading about it earlier, was BHP have tried to buy
Anglo.
That's right. Yeah. Who the big play there is copper. Am I right?
Yeah. It is. I mean, so I think there's plenty of news articles out there covering BHP and this Anglo proposed merger. They've had a tilt. Anglo have said rejected the offer. BHP will come back. Like, you know, these sort of deals don't go away, and this is just a matter of price and deal structure to make sure that all the shareholders are happy. But you know, it's pretty opportunistic from BHP. Anglo's been underperforming peers by about 20% over the last sort of period of time. Anglo have really good assets. The copper assets are very good, and BHP are making a big song and dance in the media about, you know, future-facing industries and copper and, you know, solar farms and whatever. Cool. The real reason they're buying it, if you ask me, given that, you know, Mike Henry's an ex-coal sales guy that I used to know from the coal sales days, is because he wants the Queensland coal assets. And the Queensland steel, coke and coal assets are some of the best coke quality, low vol coke and coal you can buy on the planet, and would give BHP a major, I mean, they've already got a majority position, but like a major competitive advantage out of Queensland, which is arguably the most freight advantaged premium low vol. Well, it is the most freight advantaged, highest quality, lowest vol premium hard coke and coal on the planet. So,
it's a double win though. There,
if you want to make steel now, you're talking to BHP. You have to. If you're not already, I mean, you have to. And so, you know, that will take a lot of pricing power away from the likes of SAIL in India, Nippon Steel in Japan, you know, POSCO in Korea. Like these guys who are buying, you know, boats and boats of coal every month out of Queensland. And so I think that you know, 15 million tonnes of Hay Point excess capacity and 16 million tonnes of annualised production from Anglo hard coking coal out of Queensland, all on the same train line, might not be just a mistake. I'm just going to put it that way.
I think it's a double win for BHP. They get the short term, you know, however long that might be. I mean, the world's going to continue to need steel for a very, very long time. So,
and they can play the green steel. You can play with that shit. You can play the green steel angle, right? Like, oh, it's all 100%. Going to green steel. I mean, that's the biggest fugazi I've ever heard in my entire life. But like steel industry is a naturally, you know, pretty emissions heavy industry. You can make it a bit better than the stuff that was built in 1970, but it's not that much better. Let's call a spade a spade.
The big bad wolf can't blow down a house made of steel, though, so that's why people like it.
Yeah, we like the steel complex, and I think that's a really smart buy from Mike, and I've always loved a bit of the Anglo products and what they can do with blending in Queensland. Like, we can go deep on that anytime you like, but
I mean,
I think it's a good buy. It's a really good buy, and if you want to read more about it, Benny and I have put an article up on Rask that covers it briefly.
I think it's interesting that you talk about that coal though, and how good of an asset is, because Anglo haven't been doing very well for quite a long time.
Anglo's a big business, bro. It's a big business, okay, and you know, they've got some assets like in Africa that are pretty underperforming, particularly like in the Zimplats, in the platinum and palladium sector. So
they're diamond miners, aren't they?
Yeah, they own De Beers as well. So look, Anglo's a good business. Like, don't sleep on Anglo. Okay. But yeah, you're right. They've just probably had a few. They're probably less focused than what. They're more like the old BHP Billiton. You're kind of in a bit of everything, and whereas now BHP is pretty focused. They're just in iron ore, really. Yeah. Well, they're just in iron ore. Like, let's call a spade. Everything else kind of fugazi, and they've pretty much divested everything, and now they're kind of adding it all back in again. So it's just kind of like, here we go again. So. Just watch this space. But that deal will. My tip, prediction alert.
Oh, prediction.
That deal will go through. That will happen. It's just a question of price.
Do you think BHP will overpay now because the share price is up?
No, I don't think they will. I think that whatever they do, it'll work out just fine. Too many synergies. Too much optionality, too much divestments. Like, I think BHP gets their money back. Payback period will be like 3.5 years. Like, it's pretty good cash flow. Like, you're not paying overs for it. So with the synergies, they'll be able to. They should be, and like operationally, BHP are pretty good. Like, they know how to run mines and run people and manage governments, which is pretty much the three pillars of being a successful miner. So
would you also say then that the copper is sort of like a free asset, and if it does,
they're paying for everything. They're paying for everything. Yeah, but the point is the copper is what they'll tell you in the newspaper, because it's politically palatable.
Yeah.
I don't know why steel making is all of a sudden politically unpalatable, just because like coal mining, is no dirtier than iron ore mining or any other type of mining you want to do.
People don't connect the dots, though.
They don't know. They just think that thermal coal and steel making coal are two different things.
They're mutually exclusive, mate. They don't exist. Like, one is different to the other.
Yeah. Anyway.
There was one other one. So ResMed, you also wrote an article for Rask on this. I don't know when you get any time to do any bloody work. You're writing articles left, right and centre.
I've got a sweatshop. Slave labour.
Benny. ResMed reported their Q3 earnings overnight a few days ago, and 11% were they up?
Stock's up. Oh, let me get. Should I get my victory lap? I think I might need to. Stock is up 16% in the last week. On the back of that, it had an 11% day and then a 5% day, and it's up again today. And from the low, it was like a 22. We bought it for like $22 or something like that. So $22-23. So it's $33 now. So it's like up 40-50% on what we paid for it. So I've got paid, I think, 2 or 3 dividends in between then as well. So I can just get my victory lap ready to go. Our thesis was that GLP-1s aren't actually they're gonna actually help ResMed, not hinder it, and that yes, there might be people with obesity being less obese, but it's also a massively under-addressed market and under-penetrated market, the sleep apnea market. So, and we think that ResMed's going to continue to dominate. Last night, Philips had some court staff that was favourable for them, and ResMed, came off a fraction, but doesn't really change the dial. I don't think we're going to see practitioners heading back to Philips anytime soon after their recall. We're pleased with ResMed. It's been a really good stock pick. It's one of our biggest, if not our biggest, overweight position in the fund.
And I wouldn't have asked you if I knew that it was just going to be a humble brag.
Bit of me time. So the victory lap will continue this week.
Well done,
after making squillions. And
well done. Luke picked one stock. That is Active Management. No, I'm not joking.
He's a hard sell deal. He really is.
Look, I think we should wrap it up there. Well done, though.
No, I'm happy. Very pleased with myself. Very pleased with
jump
myself.
on Rask and read those articles. We'll put them in the show notes alongside the Livewire article talking about thematic ETFs. Enjoyed this, mate. We'll catch you next week.
Excellent job as my PR agent this week, plugging all my content. So thanks very much.
Just you wait. We'll be on the Facebook for adults, or LinkedIn as I Facebook for working professionals.
Facebook's for grandmas now, isn't it? Isn't that what? Is that the other?
No, Facebook's basically Gumtree now in my household. Gumtree doesn't exist. You just use Marketplace. Yeah. And it's a great place to get rid of the golf clubs that you think are making your golf game worse, but actually you're just bad at golf.
To only spend $2,500 buying a new set, and then
and don't get any better at golf.
100%. Oh, this is. I'll finish on a quote from one of my good mates who says, "If you find your golf game's going to shit, you're just not spending enough money on it," and that's his solution. Is you just throw cash at your game until it gets better, and I reckon it's not a bad way to go about it.
I think it's a good thing. It's a good thing that the beers are cheap at the clubhouse because I don't have any money left after all the money that I spent on my clubs.
Excellent, mate. Thanks very much for that one. I'll catch you next week.
Have a good one, mate. Talk soon. Bye.